friend from the state of Oregon, Peter DeFazio.
Thank you. You know, I think the American people are a bit confused as to what's really going on here, and it's, you know, a lot like the Humphrey Bogart movie. What's going on here is gambling, plain and simple. It would be one thing if these so-called investment banks like Goldman Sachs were lending into the productive sector of the U.S. economy. They were lending to people who have good ideas to produce products and goods, employ Americans, and help us, you know, compete in the world economy. But they're not doing that. In this case, they weren't even helping to package and move mortgages off of people's portfolios and someplace else. They were merely mimicking with what are called synthetic collateralized debt obligations, packages of bad or potentially bad mortgages to bet on. You know, for this one hedge fund to bet against and make $1 billion. And, but then, of course, unfortunately, other parts of Goldman Sachs, apparently unbeknownst to them, I mean, in totally good faith, went to clients of Goldman Sachs and said, hey, we've got a great product here we'd like to sell you. Unfortunately, other parts of Goldman Sachs had assembled this product with the intention that it would fail, and these other people were not informed of that fact in purchasing them, although, you know, Goldman would say they didn't have an obligation to tell people that they had designed it to fail, working with someone who was betting on it to fail, and that Goldman itself was betting on it to fail. But the bottom line of all this is it's a huge amount of churning on things that don't help our economy, help the American people, help us compete in the world. Goldman has gone to the point in 2007, their gambling income, excuse me, their financial services investment, you know, self-proprietary, et cetera stuff, however, whatever you want to call it, was actually 5 times larger than their investment banking activities. So 20 cents of every dollar at Goldman was going into productive investment. The other 80 cents was going into gambling on imaginary products. It's a lot like fantasy football. A lot of Americans can understand that. Imagine if they took out and created synthetic you know, products that related to fantasy football. Maybe some Americans can understand that. Recently, one firm actually proposed, Cantor Fitzgerald subsidiary, proposed to do futures on movies. So in LA, they would produce a movie, and then the people on Wall Street would bet on what the opening weekend was going to return, and they would bet on how much money it might make. This became of such concern to producers in LA, because they thought, my God, if they start out shorting us right away, then that's going to depress, you know, our investment potential for the movie, et cetera, et cetera. So they've actually, in the Senate bill, they're actually banning this sort of derivatives. So they've banned 2 kinds of derivatives. One has been historically banned for some reason, lost to the mists of time. Onions, you can't do them on onions. And the second would be movies from Hollywood. But otherwise, you can bet on anything. You could bet on the weather tomorrow as a derivative product. You could market it on Wall Street, you know, et cetera, et cetera. This is not a productive activity. I would suggest, you know, a simple way that's good is the Senate has actually, for once, proposed something useful, which is to say that if Goldman wants to have a proprietary trading section and trade in these gambling products, that they couldn't draw money through, be insured by the FDIC, or draw money through special windows of the Treasury. We should not subsidize their addiction to gambling. The taxpayers should not subsidize it. That would be a good step. But the other thing we could do would be to put a very modest tax on this gambling, and to say, look, you know, for legitimate hedgers, airlines who want to, you know, hedge against fuel price increases, farmers who are worried about failure of the corn crop, those people, you know, we already distinguish between hedgers and speculators over at the Commodity Futures Trading Commission. Let's just say hedgers would be exempt from the tax, but speculators, those who have no skin in the game, aren't producers, or even worse, are not even actually involved as in any way as a counterparty, but just merely creating synthetic things to bet for or against, they would pay a very modest tax. And if the tax was approximately 0.2%. That's 0.0002 on each of these trades. We could raise somewhere between 30 to 50 billion dollars a year to help pay for some of the damage they've caused to our economy. It might not raise that much because it might rein in some of this speculative activity, which I think would be a desirable impact. But I would suggest that that would be one way to deal with this very, very reckless activity. And I congratulate the gentlelady for having this hour to highlight these concerns and the contradictions that we see in the business principles versus what we all saw go on. So with that, I'd yield back.
I thank the gentleman for his great commentary.